President Trump is expected to sign an executive order in coming days aimed at opening up 401ks to private assets. Sharon Epperson joins us now with more on what that could mean for 401k investors. Good morning, Sharon.
Good morning, Melissa. Well, an executive order does not have the same weight of law, but it sends a strong signal that could encourage 401k plan sponsors to include private assets in their offerings. Now, that's a big market. There are more than $12 trillion in assets in defined contribution plans. Nearly $9 trillion are in 401k plans alone, with more than 70 million participants. While that's also a big number, the average 401k balance is less than $130,000, with baby boomers holding just under $250,000 and Gen Z having $13,000 on average. That's according to Fidelity. Private market investments provide diversification as non-correlated assets for high net worth individuals, but financial advisors say private assets may not be right for most 401k investors.
Hard enough time getting the basics and the fundamentals, down for most investors. It's hard to be consistent and disciplined just with passive investments, just with sticking to a strategy that you can hold on to for the next 10 years. So now we're going to introduce some complexity to that. It might not be the best idea.
Stock and bond funds, private assets have high fees, lack transparency, as well as liquidity. And for those reasons, analysts expect most plan sponsors will be slow to adopt private assets into their retirement offerings. But 401k investors could have more alternative investments over the next several years available to them in their plans. You'll find a lot more information about retirement saving and investment strategies in my free Money 101 newsletter. You can sign up using the QR code right there on your screen or go to cnbc.com/money101.
Some 401k providers are already offering this. So what has been the response of the participants?
Well, some of them are offering the access to them through collective investment trust, through pooled vehicles. That is something that Empower is doing on its platform. But plan participants, while they want to see more diversification, they want to see higher returns, the trust and understanding of what actually private assets are and how that could work for them, that's a little bit out there. They're not exactly sure about that. And so there's some hesitancy in terms of including that into your 401k because they just may not understand it or understand, what they're going to be able to, how they're going to be able to see how these are performing because you don't have the same.
There's a reason you always need to be a qualified investor for some of those things. But I would still think if you're 30 years old, it should be like an energy policy. It should be all in. Everything should be, maybe not blackjack or something, but almost anything should be, offered. At least you could choose, because you could miss out on something that compounds at 22% a year.
The issue, I think, for plan sponsors also is, well, first of all, people want to know that I'm in a company that I know, the company that I may not understand that well, but the majority of companies that right now are private firms. So if you have over $100 million in revenue, 87% of those are private firms, only 13% are public. And so they want to have that access and that diversification. The problem is because it's not as transparent and people aren't as sure what's in there, there is concern about the fiduciary responsibility that plan sponsors have to make sure that they are providing products that are for the best interest of the participant. The litigation risk is what is stopping a lot of firms from doing this or making them more skeptical about how they're going to do it.